Okay, hi everyone. This is the 11th lecture of Monetary and Financial Economics B2. So today is the last lecture. Yay. So please keep your best. Okay, let's move on to today's content. So today we will cover these four contents: structural features of developing countries, developing country borrowing and debt, the Asian financial crisis, and lessons of the developing country crisis. Now, first topic is the structural features of developing countries. So there are several structural features of developing countries. History of broad direct government control over economic aspects. History of high inflation. A large number of weak credit institutions due to the liberalization of domestic financial markets. Strict government control of the exchange rate. Exports of natural resources and agricultural commodities. Rampant bribery and extortion. Okay, so first feature is broad direct government control. So because such developing countries tend to control governments in the developing countries tend to control the wider aspects of economy. So these countries are far away from a liberal capitalist economy, such as advanced economies. So there are several restrictions and controls in developing countries. So the developing countries have restrictions on international trade, government ownership and control of large industrial companies, direct government control of domestic financial transactions, and a high level of government consumption as a percentage of GNP, etc. So there are several restrictions and controls, but so these days, such controls tend to be weak. But how much government involvement has weakened varies from country to country. Second feature is high inflation. So emerging countries and developing countries tend to be large, significant government spending and losses of state-owned enterprises. So therefore, such country tends to not be financed by tax revenues alone. So there faces shortage of money. And also such economies have a tax evasion in the formalization or undergrounding of many economic activities. So therefore, developing countries print money to finance economic activities. Then such printing money activities causes inflation and in special case, hyperinflation. So real resources obtained by the government by printing money and spending it on goods and services are called seigniorage. So such governments try to get seigniorage by printing money. And such printing money activity causes inflation. The third one is weak credit institutions. Banks in developing countries invest borrowed money in unprofitable or high-risk projects, or investments in developing countries are made based on personal connections rather than the expected earnings. In addition, government safeguards against financial vulnerabilities, such as banking regulations, are ineffective due to the lack of capacity and experience. etc. So therefore, these countries, developing countries, tend to be vulnerable to crisis. Number 4, control of the exchange rate. Even if the exchange rate is not explicitly fixed, it may be controlled by the government like China. So such governments try to control inflation or try to prevent sudden fluctuations in exchange rates. And also, some developing countries have exchange controls, assigning foreign exchange by government decree rather than through the market. Number 5, I guess. Exports. So most exports are natural resources and agricultural commodities in developing countries. Number 6 is the bribery and extortion. So corruption itself hurts economic efficiency and growth. Corruption and poverty are the same. So this is a very interesting graph I used from the textbook. So in here, vertical axis is inverse index of corruption. And horizontal axis is annual per capita output. So you can see that, inverse of the index of corruption, so means that cleanest country is record 10. So you can see that there is clear relationship between aggregate annual per capita output and the inverse index of corruption. So you can see that cleanest country tends to have high output. Poor country tends to dirty. Okay. So such features are formed in 1930s, basically. So such features are created due to the Great Depression. Many developing countries tried direct controls on trade and foreign debt to preserve foreign reserves and protect domestic jobs during Great Depression. So government intervention and control of the economy remained in developing countries after the crisis. Political system perpetuated political system perpetuated by those with interests in it. The next topic is developing country borrowing and debt. Recall that the current account determination. One determination is current account is equal to the savings minus investment. CA equal to S minus I. Then, if domestic investment is greater than domestic savings, then current account becomes deficit. So developing countries tends to be low saving rate and there are few capital. There are too few capital. So therefore there are so many opportunities for building and expanding factories and facilities. Therefore, they face strong investment. They can borrow funds. They borrow from abroad, and then current account turns out to be deficit. In contrast, developing countries, they have so much capital, and there are few investment opportunities. So therefore, developing countries tend to invest in developing countries and lend funds to developing countries. However, there is also a possibility of unprofitable investment like construction of buildings and factories with no demand, etc. Sorry. So, therefore, developing countries tend to, the current account in developing country tends to be deficit due to the falling investment, high falling investment. But this trend changed from around 2000. Developing countries began to run current account surpluses, not deficits. There are two reasons. The first reason is due to the huge current account deficit in the US due to the global imbalance problem. So please see the past lecture slide. And the second reason is the accumulation of foreign exchange reserves by developing countries. So developing countries faces several crises, as I mentioned later. So to prevent such crises, developing countries try to accumulate the foreign exchange reserves since around 2000. Okay, so let's move on to the next topic or word, default. So default means that failure of the borrower to repay the loan on the schedule outlined in the loan arrangement without the lender's agreement. So loans to developing countries are said to be high risk, and there are high risk of default. So this is because of social and political instability of developing countries. Okay, default probability increases when a country faces a sudden stop in inflows that suddenly loses access to all foreign sources of funds. So sudden stop means that the sudden stop in inflows, in financial inflows. Let's consider the example. Current account is 5% deficit of GNP. Sorry, the deficit is here. I don't know, spell deficit. Sorry, so CA current account here is 5% deficit of GNP. So suddenly, foreign lenders fear default and cut off new loans to developing countries. Then in the developing countries, the current account must be surplus. So GA should be non-negative. Because CA current account is S minus I, so S minus I must increase by at least 5% of GNP. So to do so, S savings increases or investment decreases. So such increase in saving or decrease in investment causes aggregate demand decreases. So output decreases by reflecting aggregate demand decreases. Then earnings also decreases and larger probability of default. So the increases, so the fall of earnings makes the probability of default increase. Okay. But actual situation is even more challenging. Lenders demand repayment of existing loans. So lenders try to not only stop new funds, but also require the repayment of existing loans. So then when borrowers try to repay the principal of their debt, they need to increase net foreign assets. To do so, they increase net exports. Then the strict current account surplus is required. So CA should be strictly greater than 0. Also, in developing country default crisis, balance of payments crisis and bank runs often occur together. So they are much more severe crisis. So the crisis becomes much more severe. Sovereign default is a government default. So the sovereign default is a situation that a government defaults on its debt. So in developing countries, sovereign default and private default often occur together. So such default events aren't seen for the 30 years after World War II. So there are not much default events was seen for 30 years after World War II. So this is because limited debt issuance by developing countries and lenders are usually governments or the International Monetary Fund and the World Bank. So therefore, the lenders borrow, so developing countries borrowed from official institutions. So therefore, they did not default for the 30 years after World War II. But since the liberalization of private capital flows in the early 1970s, major default crises have more recurring event. So after the liberalization of the private capital inflows, there are so many default crises in emerging and developing countries. So there are several alternative forms of financial inflow. So such forms can be divided into two groups. First one is debt finance, and second one is equity finance. So debt finance and equity finance are what we learned in the past lecture. In the previous, I guess, I forget the lecture number, but so we already learned the debt finance and equity finance. So first one, so in the debt finance, there are bond finance, bank finance, official lending. Equity finance, in the equity finance, there is foreign direct investment, FDI, and portfolio investment in ownership of firms. So recall that debt financing is that regardless of changes in economic conditions, a set amount must be paid. So even if the economy gets going down, debt financing requires the fixed payment. So the required repayment of fixed amount. So therefore, under the debt financing, if economic conditions worsen, repayment becomes much difficult. In the worst case scenario, default occurs. So default easily occurs in debt financing, even if the economic condition worsens. So debt of developing countries is often set in major foreign currencies like US dollar, euro, Japanese yen, etc. So this is because lenders seek repayment in the lender's currency, like US dollar, for fear of extreme currency depreciation or inflation in developing country. So developing countries need to repay with US dollar or euro or Japanese yen, so foreign currency. So if the debt is repaid in the foreign currency, home own currency, it can be repaid by printing money and not defaulting. Although inflation will lower the value of the home currency, but default doesn't occur. So this is a case of repayment in the home currency. But again, so developing countries must repay in major foreign currencies. So this situation is called original sin. So original sin is a situation where emerging and developing countries cannot borrow in their currency. So they borrow not in their currency, but in foreign currency, foreign major currencies. Okay, now let's move on to the third topic in the next video.